Let me introduce myself again. I'm Keith Haskell. I'm a certified financial planner, and I'm also an EA. And you say, what is an EA? I did this primarily because people ask me all the time, where do you go here, where do you go there, to find some good information, excuse me, or, most of the time, in fact, all the time, if it has anything to do with legal matters, I call her. And if she can do it, fine, but sometimes, she can't do it. She doesn't specialize in one particular area, okay? And she's smart enough, and I'm smart enough to know that we're not going to get into something, that we don't know, okay? Because, there's a lot more attorneys out there that would probably like to take some of our money if we don't. So anyway, that's why I did this, because I have a lot of people asking me that. And so I say, to represent taxpayers before Internal Revenue Service, there's actually 3, okay, that are on the statutes, okay, and one of them happens to be, an attorney. Now, I'm not discouraging you to go to any one of those, okay? It's just a matter of, I get this all the time, so I thought I'd run through it real quick, okay? The attorneys have lots to do. You've got bankruptcy attorneys, you've got, estate planning attorneys, you've got business, corporate attorneys, criminal attorneys, but the main one you're looking for, if you want to go to your attorney, is a tax attorney, okay? They are very smart, okay? So they don't do everyday tax returns or anything like that, all right? But when you have to go to tax court, let me move over here a little bit so everybody can see, okay? So, you can use them. And I would, if I was doing it and all of a sudden we got into some trouble, which we won't if you come to me, but anyway, because, basically I've been doing this for 50 years. Yeah, about 50 years. Thank you. Yeah, I'm all right for now. But I try not to, okay, and I ask enough questions to make sure, okay, that you don't get in trouble. So, but... So you want, if it's a high number that IRS is trying to take out of your pocket, that's probably where I would even recommend you. Okay, although I can go to tax court, never been there and don't want to. Okay, so get a hold of a tax attorney. Okay, the next one is a certified public accountant. Now most people think, okay, well if I go there, they can help me. Again, though, there's a variety of them, okay, for CPAs, all right? They've got an auditing department and an accounting department. What you have there, though, is that probably 80% of CPAs are in the auditing department. They don't have a clue about taxes. You would think that they would, but they don't, okay? So, again, they have an excellent tax department, though. So if you're familiar with one, you can just go to a CPA and ask them about their tax department, okay, and ask who they recommend. Or you ask anybody, that's the best thing to do. I've never advertised at all, okay, in my 50 years. And the Lord just blessed me. He just blessed me by sending people to me. So, let's see. Then, of course, you've got enrolled agents, okay, to practice before Internal Revenue Service. That's the EA. I am one of them, okay? So, but we specialize in taxes, okay? And that's pretty much, I don't do, by the way, I've had many ask about, would I draw up a trust form because they think I do something like that. Guess what? I don't do that, okay? I was telling some people here that the problem is that who usually is in a tax or in a courtroom all the time? Attorneys. Why would I think about doing their work? Because they're just going to turn around and sue me for it, right? So because that's a legal matter, okay? It's not an accounting or a tax matter. So anyway, and we have continuing education, and that's where I was this past week for 2 days, for 8 hours. And that's why I'm not as steady as I used to be, because they will drive you nuts. So anyway, what I was talking about, so hopefully that'll be helpful for you to figure out where you need to go. Okay? If not, just call me. I'll tell you. Okay? Now, required minimum distributions. Okay, RMDs. I'll refer to them for that, okay? Major changes based on the Secured Act of 2019 and 2.0. One of them was in 2019. I think the other one's 2022, as I recall. Okay, starting RMDs based on when you were born. I don't like this. Yeah, I wrote it. But I don't like it because be honest with you, I can't understand why they're saying born in, 1950. It's actually born before 1950. That's what I figured out. So, but anyway, here's the new deal. Prior to 2020, you had to be 70 and a half years old, before the RMD came into effect for you, IRS changed, actually Congress changed the law and made it now that when you hit 72, that's when you start your required minimum distribution. Don't let me get on these letters and confuse you. It's a required minimum distribution. Then they said, well, we don't like that either. So the following year, they made it 73. So now you have to be 73. Then that's when you're required to take a required minimum distribution. Didn't like that either, I guess. So let's see, 2033 is what I have up there. That's when you have to. That's when you're 75. Then you have to take an RMD, required minimum distribution. What we're talking about basically is out of all your retirement accounts, not just IRAs. We're talking about all your retirement accounts, 401ks, 403bs, 457s, SEPs, IRAs, of course, You add all those up, all right? By the way, I will take questions, Also, because this is in such bad shape, I'd be more than happy if you leave me your email, if you want me, because I am going to redo this, I hate things like this where, all of a sudden I said what? But anyway, so if you want me to send you a new copy of the sheet here, then I'd be more than happy to send that to you, but I need your email, name and address, that kind of thing. So got me there? Next one. Says first year, the RMD is required at 72 years old, which I already said to you there. I wanted to give you some kind of idea what they do. They have a table that you have to use, when you reach that particular threshold in your life, So the 72 is what you see there. Let's say that you had $100,000 in all your retirement accounts. You hit 72, Then you look up on the table, and the table says 24.7. You divide the 100,000 by the 24.7, and you get that 4,049. Now what's happening there, if you see that, if your divisor, is reduced, because the second year, it's 23.7, Do you see what's happening, though, with the dollar amount? The dollar amount is going up, because of the divisor, So I did one on, if you had let's say you had 98,000, and you used the 23.7, your dollar amount would be 4177. So if you have a lesser amount, it's going to be a lesser amount that you have to take out. It's going to be more, like 101,000. And the same divisor, it'd be 4262. Everybody understand that? because, you know, there is a table out there, and you can probably find, like anything, you can find it on, you know, on the internet, because I get that question all the time too. Okay? All your retirement accounts, okay? Not just IRAs on that. Okay? Now, here's the problem. Here's the real problem. The new law, okay, having to do with inherited IRAs. And I'm sure everybody's interested in that. Okay, and that is a mess right now. Let me tell you how these things come about, by the way. They come about because Congress is the one that's doing it. Obviously, like I said, they don't have enough money. So, you know, they have to get it from us. That's what always gets me, too, is when they're talking about that. You know, their money is our money. Okay, it's not their money. But they, you know, do this. What happens is they've got conference rooms, okay, and they've got a small group of all the Congress, okay, that comes up with these laws. And then they turn around and they have scribes, what I call them. They're probably 25 years old, just out of college. And they're the ones that are listening and writing what they think the congressman said. Yeah. So when they do that, then they take it to the floor. The floor then turns around and votes the law in, okay? You think most of them read that? No, they don't, okay? So the law goes, you know, into effect once they vote that, you know, like this change here, the act, it's called the Secured Act, okay, of 2019. Then they didn't like that one, so in 2022, they came up with a Secure Act of 2.0. Okay, and they're going to come in with another one as well shortly, okay? So what they're talking about is in the inherited IRA that I see, okay, the spouse that's inheriting the retirement account, they didn't change that much, but the one that really changed is a non-spousal, okay, inheritance. They changed that a lot, and what they basically did to it is they didn't like what they called a stretch IRA. Okay, what that means basically is you could stretch out an IRA probably 50, 60 years if you wanted to, if you had that many, you know, children, grandchildren, and so forth. They didn't like not getting their money. Okay, so what they did is they turned around and put a 10-year gap on it, which basically means that in 10 years, as you inherit money from somebody, okay, from your mom or dad, let's say, okay, and actually, let's say you're an uncle or an aunt or somebody other than a spouse, okay, they're going to make that particular person pay, okay, the IRS in 10 years. Now, before that, in the prior years, okay, they could stretch it out, like I said, you know, for a long, long time. But in prior years, though, they said that you could either pay it annually or you could pay it in a lump sum, okay, during that 10-year period. This new law, they neglected to tell us what it was going to be. Okay, so I've got a publication there with Bob Carlson, who's a tax attorney, he's a CPA, and he's even confused, okay? We don't know, okay, how they want us to distribute that money, whether it's going to be annually or whether it's going to be in a lump sum. I have a lady that, up in Maryland, okay, that she inherited, it's about $1 million, okay? Yeah, it'd be nice, wouldn't it? Write me a letter, tell me where I can become somebody's gopher or something. But anyway, so she didn't know. I recommended to her that since we didn't know, okay, that she at least starts it annually. She did not. So, the nice part about that is that it looks like IRS is going to postpone the penalties on those things. Yeah, 22 for Yeah, the 22 one and the 21. Okay, they're going to do that because that's the problem. They don't know what, they don't know what the law is going to do to them. And everybody's confused. And in fact, one of those things is having to do with the 22 year, okay? Some people just, paid it anyway. Then they turn around and say, no, you didn't have to. So now you got to send it back. And you have 60 days in which to do that, and if you don't, they keep it. So it's, pretty strange, So, let's see, rules, date of death. Yeah. If you see down at the bottom of that one, okay, it says, problem, IRS will not make a final regulation until 2024. This has been going on 3 years. So nobody knows what to do. So I'm recommending that you do it annually. Why? Because that's what you had a choice of in prior laws. So that's one of your major problems. You can ask questions if you want to on those. Not that I have an answer, but you can ask them. Okay. Well, you see, it's just something else because this next page basically tells you, okay, about the spouse. The eligible designated beneficiary. That's the name that they gave, the spouses, the chronically ill, the disabled, and the minor. Okay, all these people, okay, are going to have a much more flexible way to pay the RMD, or required minimum distribution. Okay, the minor, I just asked Lynn about that. Okay, the age of majority, as it's called, I guess, is did you tell me 21? 18? 18, okay, so, and the way that works is kind of interesting because let's say that you do have an 18, well, actually, let's say that the person is 15, okay? When they get that money, they don't have to do a thing with it, okay? I mean, they can spend it if they wanted to and everything, but still not pay the taxes on the thing. So they don't pay until the age of majority, okay, which is 18. After that, then they fall in that 10-year category where they have to pay it back. All right, so nice way to get money, huh? But like most people, they forget about taxes. And I can't let them do that. So, okay, rollovers is 60 days still.
Siri, here.
Let's see, DC service. Okay. Oh yeah, this is an interesting one too. Down where it says if deceased. Okay, what they're talking about there is, let's say that you have a person, okay, that was on RMDs, required minimum distributions. And there's a table for that, by the way, okay? You look at the table, and it'll tell you how much they have to pay of their retirement, okay? Pay taxes on it. What they're basically saying is that if that particular person, and it's a mortality table, that's what it's really based on, if they have 5 years or less to go based on that mortality table, the inheritor has to pay the full amount of taxes. Okay, if they have more than that, okay, more time, they know almost exactly when we're going to die, I guess, is what they're trying to tell us. But nobody but God knows that. So, but anyway, if they got 5 years or more on that mortality table, then they can take the money and put it in their own, IRA account. They can do a lot of things with it, okay, because basically, the spouse has a lot of rights on this thing. So they didn't change, like I said, they didn't change that particular part of the law much as far as spousal IRAs.
A comment and a question. First, the comment, if it was anybody but the government, they wouldn't have picked a number like 20 to divide by. They would have told you what percentage they were taking out, right? 5% or 6%.
Yeah.
But only Congress can do that. So that's my comment. You're welcome.
Thank you.
In establishing a Roth IRA, our IRA is just in my name because it was a 401 conversion, 401k conversion. If you do a Roth out of that, can it be a joint IRA, or is it still just in my name with a beneficiary?
You know what IRA stands for? Individual
Yeah.
retirement account, okay? Has to be individual. I've got people that ask me that question all the time, so I don't feel bad about it, you know,
So
it
it's
is.
the same, it's my account with
Yeah,
a beneficiary.
and if you want to do a Roth, what they call a Roth conversion, is what you're talking about there, you know, put it into a Roth, okay, it has to be in your name, because technically, we try to shortcut everything, it seems like, okay? But it's called a Roth IRA.
Still,
Yeah, but same thing, it's just for an individual, yeah, so, okay? Oh, yeah, this is an interesting one, I told somebody already about this, okay? How, you know, are there ways to avoid taxes, or I should say it this way, is there a way to avoid taxes for your beneficiaries? And there is, okay? Number one, is your beneficiary, probably by the time you're retired, okay, is going to be making more money than you are. Okay, they're probably going to be in a lesser tax bracket. Now, you know, when you send that money over to them after you passed away, they still have to pay taxes on those. All those retirement accounts, you know, are what they call pre-tax dollars, which means that the owner of that IRA, 401k, and so forth, okay, is not paying taxes. Okay, if you ever looked at your W-2 and see what box 1 is, okay, versus box 3, you know, and box 1 is much less than box 3. The reason for that is because he's got a 401k, okay, because he's not taxed on that 401k as he's taken out year after year. Sometimes somebody's going to pay that, okay. You know, the old cliche of you know, making money and taxes, you know, or dying, you know, that you don't have to pay taxes. That's not the case, folks, okay? Somebody's gonna pay taxes on that IRA when it comes out. Once your beneficiary gets that money, if they take it out and it's out for over 60 days, they got a tax bill, okay? So that's what you have to watch out for. So, but one of the ways to do that is, you know, you're probably going to know whether your son or daughter are in a higher tax bracket than you are, okay? So what you turn around and do is you're the one that's going to redeem that IRA or whatever it is. It doesn't have to be all of it. It can be part of it, okay? So you can take it out little by little, because you have to watch out for that, okay? Because if you take out too much and throw yourself into that higher tax bracket, you got a problem. You don't want to do that either. So you want to pay the least amount of taxes you can possibly do, all right? Now, if you take it out, you know, or transfer it into a Roth, okay, you know, you're going to pay taxes even though you transfer it into a Roth, by the way. But if you do that, okay, then you can turn around and send the money to your son or daughter or whomever. Like me, for instance. No, okay. Okay, you got $17,000 per person that you can give to any person on the face of the earth. Okay, so you're married, okay? Dad can give $17,000, mom can give $17,000, $34,000 can go to each child if you want to. Okay, Charlie, you had your hand up?
Yeah, I was going to say there's a double tax when you take it out of the IRA, whether it's an RMD or whatever you take out. Medicare has limits, and if your income is over a certain number, your monthly Medicare payment the next year goes up. So there's IRS tax brackets, and you can also ratchet up your Medicare.
Yeah, I think I have. I don't know. I did that on one of these.
Oh, okay.
Yeah, how to calculate these. Yeah, that's actually on the next one there. So.
Speaking from experience.
Yes, I know.
That's usually the best
Yeah,
teacher.
yeah, because like you said, you know, I've got an example here. I don't think you have it on your handout there, but that will be on the new one. I can guarantee that. Okay, just to show you that, because I see it a lot of times where they've actually done that. Okay, it's a single person, okay, once they get over 25,000, okay, if they take out, you know, some more out of their IRA or whatever, okay, that, because of the fact that you took it out of the IRA and it's taxable, okay, the Social Security that you're getting goes up too, okay, because of the fact that you took it out of something else. So sometimes I get a call and they go, what? You know, but I said, yeah, that's the truth. You can make your Social Security taxable if you don't watch out, if you take out too much. Like if it goes over 25,000, okay, you can pay, you know, up to 50% of your Social Security. It was 32,000 joint, 85% of your Social Security, okay, can go on as taxable income. Then whatever tax bracket you happen to be in, that gets hit, you know, by that percentage. Not a lot of fun when you see that. So I have lots of people come in. I say, come on in, you know, let's not do it on the telephone because I can do it on a computer, you know, like twice as fast and everything else. And I say, oh, look at that, you know. They say, oh yeah, look at that. I don't think I want to do that. So that's what you got to watch out for. Okay, another might be transferred to a Roth, which is taxable. That's what you were talking about, Charlie?
Keith?
Go ahead.
Keith,
Yes.
you mentioned something about you can give anybody 17,000. Is that per year?
Yes.
So every year you can do the same thing, and them receiving it, do they have to pay taxes on it,
No.
no matter what their income?
That's right. That's right. So what you have, you know, you have to watch out for that. Now, what's that tied into? Gift tax. Exactly. It's tied into gift tax, okay? Because IRS wants to know what you're doing with every dime you have. That's basically what it boils out to, you know. So you have to watch out for that. They want you to file, what is it, a 709, I think, is a gift tax. You know, so they want to know that you're doing that. All right, now, they put limits on that. Okay? In other words, they'll go up usually $1,000 every other year, or maybe stretch it out a little bit more, because they want to know, because what Jim was asking about is the estate tax percentages and all that. If you give them over $17,000, then that other portion, okay, they know about, and they're going to reduce, okay, your gift tax exemption, which happens at the, you know, when you pass away, in other words. So you have to watch out for that. Yeah.
Question. I looked, but I didn't see the chart on it, but maybe there is. Talking about an IRA, say like I go away, pass away, leave an IRA to the wife, and I have both Roth and a traditional IRA.
Okay.
I'm talking about a Roth IRA. Now, if I pass it to the spouse, she's the first beneficiary. She has two choices, I understand. One, she can leave it separate, or she could commingle it with hers. Is that a good statement?
Yeah. Yes,
Okay,
yeah.
now, say she passes on, okay?
And she hasn't taken any money out of it.
She hasn't paid any tax on it because it's a Roth.
Right. Right.
What will happen when she passes on? Say it's split between two sons.
Okay.
Say, you know, a couple $100,000. What is the, do they have a 10-year period, or does it end when she passes?
No, no. In other words, and let's see, I had a number of those happen too, and they had to, you know, they took it out as a lump sum.
Okay, but is there a requirement that the beneficiary take it out in a lump sum, or can they do the 10-year stretch?
They can do the 10-year. Yeah.
If it passed to her, it'd be the third owner, let's say, and that's legitimate.
Yes, it is, and that's what they're trying to stop. Okay, they're trying to stop that. Okay, because then the kids can leave it in there, turn around and give it to their kids. Okay, and then those kids can, you know, it keeps on going on, and they want their money. Okay, so what they're saying now, obviously, you know, what they've changed is you can't do that. It's what you call a stretch IRA or a stretch Roth, where you can just stretch it out over and over and over again, you know. But,
That's sort of what.
but what they're doing is a 10-year now on that.
So, I'll come back, I wanna make sure I understand this. So, I croak tomorrow.
Okay?
My wife is.
I definitely hope not, but go on.
Yeah, right, but, so she inherits it. She doesn't have to do a 10-year withdrawal on her money,
Mm-hmm.
so I could commingle it with hers. And then when she passes on, she could give that Roth IRA to a beneficiary.
Yeah, I'm gonna have to look that up with the spouse. Okay, whether you give it to your spouse,
Yeah.
yeah. I'm wondering if she has that 10-year.
Spouse dies, and she gives it to a non-spouse person, which is a son. Does he have 10 years, or can
Yes,
he do it over his lifetime?
no. He has a 10-year.
He has, so it only passes down like one,
One generation, say, yeah, mm-hmm,
so it's one generation down.
right, mm-hmm.
Okay.
And the thing we don't know is whether they can do it annually or whether they can just wait until the very end. Because the smart thing to do is, if they're going to retire in 8 years, what are you going to do? You're going to hold off until the 8th year, you know, or the 9th year actually, because your income's going to drop. Okay, that means it's not going to be in a 25 or 37% tax bracket. It's probably going to be in a 12. Okay.
Yeah. All right, thank you.
Mm-hmm. Oh, yeah, let me give you my little example here. Okay, let's say that a single person, not necessarily wife, or, you know, but let's say that they are going to collect $25,000 each year. Okay, and their Social Security is about $15,000. So we're talking about $40,000 now. Okay, the single person gets a standard deduction of $14,000. By the way, does everybody understand why you're taking a standard deduction now when you didn't used to? Because of the fact, okay, they basically doubled the standard deduction and took away your personal exemptions. Okay, so what are they trying to do? They're trying to get rid of Schedule A, itemized deductions. You know, I won't even go into that. So, you know, so she took the standard deduction of 14, which she gets to subtract, okay, from the 40. Okay, you've got 26,000 taxable. Okay, now 26,000 taxable, okay, is about at 12%, I think is what I put on here, is $2,900. That's their tax. Okay, but let's suppose they took that RMD, required minimum distribution, okay, and decided to donate it to the church or to any charitable organization, legal charitable organization. The 24,000, no, the way I have this, let's suppose they didn't, okay, so, but this is what they could do. Let me back up a little bit, okay? So we've got 26,000 taxable, all right? What you could do, but she's old enough where she has to take an RMD, required minimum distribution, okay? And let's say that she could, or her required minimum distribution, is what I should say, is $24,000. Now, she doesn't, you know, she could do that, all right? But if she did not do that, and she took the RMD requirement distribution, she took it in and didn't do anything with it, okay? That's going to make her income up to $50,000. Okay, $50,000, she would pay $6,750. There's a difference there of $3,850 just for giving that requirement distribution away to charitable organizations, which you're probably going to do anyway, I would hope. Okay, so not only that is when you do that with a charitable organization, that also qualifies, okay, for your RMD as far as the government's concerned. Is everybody with me? Okay, so that's a real good way, okay, basically that IRS is not getting any tax on that requirement distribution, and you are doing what you want to do anyway, which is give the money away. Big difference. Okay, big difference a lot of times. I wrote 2 articles for church, I don't know, 5 years ago and I think 7 years ago or something like that, having to do with this. Because at one time, Congress wasn't sure what they wanted to do, okay? And in December, which I love them doing tax changes in December, but it had to be renewed every year. Now, how are you going to do the contributions when they did, they said, well, we might renew it, and we might not. So you were kind of stuck there. But about 7 years ago, okay, they decided to make it a permanent law, okay, about doing these charitable contributions. And it's actually called a, what is it? Charitable distribution. Right? So that's a good way to get rid of some of your money, okay, and not pay Uncle Sam that. Okay, the next one, traditional. Yeah, there you go. Okay, that's the new rates that you can use for 2023, okay, for a traditional IRA and a Roth, okay? Some people don't realize that you can split. You can't split more than, let's say, well, you don't look over 50, so I won't say that. No, yeah, well. So, okay, you can do, the regular limit, okay, is $6,500. But if you're over 50, you can add another $1,000 to that. Okay, so it's $7,500 if you're over 50. Now, some people think, well, I can only do it with an IRA or with a Roth. That's not correct. You could split that $7,500 if you wanted to. You can do anything you want to, okay, with that $7,500 as far as an IRA goes or a Roth. Okay? Income limits for deducting an IRA. Okay, this is an interesting one too. So as far as deducting an IRA, there's a limit. In other words, if you make too much money, okay, you can no longer make a contribution to an IRA. They changed that law, by the way, this year too, okay, because it used to be that if you made this, you could not do an IRA. Now you can, right? There's no limits on it now. Okay, but you can see right there, if you're a single filer and you make between $73,000 and $83,000, okay, you cannot do an IRA. Now, what happens is you actually prorate it. Let me put it another way. Okay, if it's $73,000 or $72,000, you get the full advantage of a deduction. If you're making somewhere between 73 and 83, they prorate it. Okay, so in other words, if you made $78,000, in other words, being single, okay, then you could do what, $3,750? Okay, if you're married, filing jointly, okay, your threshold is at $116,000 for a couple, but one couple is in an employer retirement plan, like a 401k. Okay? Again, if you're making over that 116, then you prorate it till you get to 136. If you're making over 136, you can't do a contribution. A deduction for an IRA. Okay? The next line is easy too. If you're making $218,000 or less than $218,000, I should say, and both spouses are in a 401k, then you can make the contribution to an IRA. If you're making over $228,000, you can't make a contribution again. That's what that's saying to you. That's probably the best page I did. I I guess my associate thought I was going to do this tonight rather than, sorry about that. But I will correct this thing because it's a mess. I apologize for you, or to you because of that. There was a lot of things that was going on this last few weeks. And of course, she got sick in the meantime too and everything, which is a shame, but I will correct that. Okay? So, basically, the inheritance IRA, okay, is not changed as much as it could be as far as a spouse or those other people, okay? The minor, the chronically ill, the disabled. What's the other one? Okay, I think that's it. Might be one more on there. But anyway, so I'm here. Take any questions from you. Charlie?
I have one more. So I'm retired, so the only way I could put money in an IRA, in a Roth IRA, is to take it out of the traditional IRA, pay tax on that, and then open it.
That's correct. Why? Do you know why? Earned income.
Huh?
Earned income. You must have earned income to contribute to an IRA. So anyway, you can take it out as do a, what they call a Roth conversion. Here's another one for you. I forgot to put that in there.
Can I do that for her out of my IRA, or is that limited to just doing one for me?
It's limited, yeah. Yeah, you can't do it for her, I don't think.
It's capital I.
Yeah, capital I. Yeah, that's right. Right, okay. So, let's see, there was another one I was thinking about too. Ever heard of a backdoor IRA? Huh? Okay. Yeah, no. A backdoor IRA means, let's say you're over those limits that I just told you about. Okay, let's say you're over those limits, but you still want to do a Roth. Okay, what you do is you go on and contribute anyway to an IRA. You tell me about that you did it. I say, oh, I'm so sorry. You're not going to get a deduction for that. But why don't we put it into a Roth? Okay, IRS allows you to do that. Even though they know that you knew, okay, that it wasn't deductible. It's not deductible, but it's a way to get it into a Roth, okay, then, and if you're middle-aged, that can be a real, nice advantage because of the fact that you have to be 59 and a half, and you have to have the Roth 5 years. Once you qualify for those two things, you can take it out. Because it's the money is a non-deductible, okay? You never paid, taxes on it, but that's a way to get it in there. You did pay taxes on it already, okay? So, but you can do what they call a backdoor IRA, and I looked it up. It's in the book, okay? So you still can do that.
I want to understand that a little bit. So you're saying a person could make a non-deductible IRA contribution. And
Right.
let's say it's $6,000 just for round numbers. So that person makes that. Then you're saying, oops, I want to do it into a Roth. So they do a Roth conversion. Okay? Now, let's say that thing grows for 10 years and it's now worth $15,000. So there's a $9,000 gain in that Roth IRA. Under normal thinking, you'd withdraw that and not pay any tax on it. Is the government foregoing that $9,000 of gain that conversion made?
Basically, they are, okay?
What?
Basically, they are,
They are.
okay, because of the fact that, okay, you put the money, see, you said something about earning it or something like that. In other words, this is done basically by taking the money, okay, and putting it into or saying that you put it into an IRA. I need to get some water. Yep, an IRA, okay. You go to there it is, Lynn, right there, please. Okay, so you go to, thank you, sweetie, I appreciate that. So you go, okay, to your tax accountant, okay, and you tell them you made a IRA contribution. They say, oh, woe is me, you're making too much money. You know, you can't use that as an IRA. So it's called a non-deductible IRA.
Right, years ago, that's how some people did it, like 30, 40
Yeah,
years ago.
yeah. But now you can do something about that, okay? You can turn around and do that. Then you can, go to your broker and say, okay, now convert that, okay, to a Roth for me. And you can do that immediately, okay? No tax consequences on it.
That's nice.
Yeah, they'll fix that.
Yeah, they'll fix that eventually. Yeah, they'll fix that eventually. But it surprised me too, because it's been around for a number of years.
Yeah, I've only become aware of the last few years.
Yeah, but that's what they call them.
Years old, and I started making IRA contributions whenever I could.
Mm-hmm.
I think they came in the 70s, mid or late 70s, and
Yeah,
yeah, okay, because that's nice to know.
yeah, I've got a Roth, and by the way, Charlie, what you could have done, okay, although Peggy wasn't working, okay, you could have split it, okay, and made two Roth IRAs. Even though she's not working, if you make enough, like over $15,000, okay, you could have had two Roths,
Yeah.
okay? So,
Yeah, I think that's still the way, right? If
yeah,
you're a married couple and one doesn't work, you can split it some way, because I did that for years.
Yeah.
Every other year, I did that with my wife.
oh yeah,
Yeah.
better be your wife. Because I said, no, I didn't say anything. Yeah, I've done it with my wife for years too, yeah, for years. So, she's got more money than I do. So, okay, other questions? Thank you very much, and again, I apologize for sitting here and doing that thing and everything else, but really, I'm going to fix that, okay, that handout, so if you want me to send you one, I will. Be more than happy to. Okay, just,